So what if I told you there's a way to make your existing assets, we're talking your stocks, your crypto, work twice as hard for you without you having to sell a single share? In this explainer, we're going to break down a really powerful strategy that aims to do just that.
I mean, really think about that. Imagine building an income engine right on top of your current portfolio, and it doesn't disrupt your long-term holdings at all. Now, I know what you're thinking. It sounds a little too good to be true, right? Well, today, we're going to show you exactly how it's done.
Okay, first things first. We've got to build the foundation of our income-generating machine. Before we can start earning anything, we need to assemble the core parts that are going to power this entire strategy. Now, this entire system runs on a special type of account called portfolio margin. Think of it this way. Instead of looking at each of your investments one by one in a little silo, portfolio margin looks at the big picture. It gets that if you have a position in one stock and, say, a counter position somewhere else, your overall risk is probably lower. It sees the whole chessboard, and that holistic view, that's the key that unlocks everything else.
So what is it exactly? Well, portfolio margin is a risk-based system that analyzes your entire portfolio to figure out your total exposure. And based on that, it gives you buying power. And here's the absolute crucial thing to understand. You are not borrowing money and paying interest. You're just using the value of your assets to back your trades.
And this is really the core mechanic of the whole thing. Your stocks and your crypto, they become the collateral. And that generates this pool of buying power that you can then use to go sell options and collect premiums. All the while, your actual cash just sits there, safe on the sidelines, totally untouched. Let me say it again because it's so important. You're not borrowing, you're collateralizing.
Okay, so we've built the foundation of our machine. Now for the fun part. It's time to fire up the engine. In this next section, we're going to dig into exactly how to turn that buying power into a steady stream of income.
The tool we're going to use here are LEAPS. Basically, they're just options with more than a year until they expire. And this slow motion game is so important because it has low gamma risk. Now, in simple terms, gamma just measures how quickly your exposure changes when the stock price moves. With short-term options, a tiny little stock dip can cause this massive, terrifying spike in your margin needs. LEAPS just smooth all that out, which protects you from those sudden shocks.
The central play here is selling naked puts, and the best way to think about this is that you are basically acting like your own little insurance company. You're selling crash insurance on really high-quality stocks that you wouldn't even mind owning anyway, and you collect a nice premium for doing it. A naked put is just an obligation to buy a stock at a price you agree on if it falls below that price. So you're literally getting paid to set a lowball buy order.
Let's make this real with an example. So here we are selling a one-year put on Amazon with a strike price of $130. For that, we collect a premium of $1,200. But here's the kicker. We only need to tie up $2,600 of our buying power to make this trade happen. Now, when you run the numbers on that, that's a 46% return on the capital being used. I mean, come on, you'd be hard-pressed to find that kind of return almost anywhere else.
And this quote from the source really just nails the magic of what's happening here. You have manufactured a return. You haven't invested any new cash, you haven't sold a single one of your long-term holdings. You've just used the hidden value of your existing assets to create a brand new income stream, basically out of thin air.
This brings us to the secret sauce, the dry powder advantage. And honestly, this is your superpower as an investor. Because your cash isn't tied up securing these puts, it is completely free. It can sit in a high-yield account earning you interest, but more importantly, it's ready to go. It's your sniper fund to buy incredible bargains when everyone else is panicking. This is how you play offense when the market is on defense.
Okay, this all sounds fantastic. Almost a little too easy. But listen, with great power comes great responsibility. So now we have to talk about the most critical part of this entire explainer, the art of survival. Because a machine this powerful needs some really robust safety systems.
We have to ask that terrifying question. What happens when the absolute worst-case scenario hits? When your collateral and your trades both go against you at the exact same time. This is the dreaded correlation trap, and it's the nightmare that can keep even the most experienced investors up at night.
So in a normal, calm market, everything is rosy, right? As this chart shows, the value of our collateral, let's just say it's mostly crypto for this example, is high, it's stable, and the liability from the puts we've sold is just a tiny, manageable little blip on the radar. Everything is in perfect, harmonious balance.
But then the crash comes, and this is where the strategy can turn into an absolute nightmare. It is a vicious double whammy.
The value of your crypto collateral plummets at the exact same moment that the liability on the puts you sold skyrockets. Your assets shrink while your liabilities expand. This is the perfect storm that leads to a catastrophic, account-destroying margin call.
So how do we prevent this financial apocalypse? How do we survive it? Well, it all comes down to one simple, non-negotiable rule: the 30% utilization rule. This is the single most important discipline you must have to run this strategy safely and navigate any market storm.
This donut chart shows you exactly what we mean. If your broker gives you $100,000 in buying power, you only ever use 30,000 of it. That huge 70% slice is your safety moat. It's the massive buffer that absorbs the shock of a market crash and keeps you far, far away from a margin call. This isn't just a buffer, it's your financial fortress.
And the second rule is all about discipline over greed. It's the 50% rule for taking profits. If you sell an option for, say, $10, the moment time decay and market moves bring its value down to $5, you buy it back. You lock in the win, you free up that margin, and you get the risk off your books. Don't get greedy trying to squeeze out that last dollar. Take your profits and live to trade another day.
All right, so we've built the machine and we've installed the critical safety features. Now it's time to level up. In our final section, we'll talk about mastery and the final edge. These are the advanced techniques that will take your income-generating machine to the next level. One really powerful tactic is what's called the 6-month roll. So you sell a 12-month leap, and then, as this timeline shows, right around the 6-month mark, you buy back that original option and you sell a new 12-month leap. So why do this? It constantly keeps you in that sweet spot where time decay is working its magic for you, but that pesky gamma risk we talked about hasn't started to ramp up yet. It's like constantly resetting the clock to your advantage. This next concept is absolutely crucial for picking your targets. You don't just pick a strike price based on a chart. You do your homework. First, you calculate a company's intrinsic fair value. That's what the business is truly worth based on its fundamentals, cash flow, earnings, separate from the noisy market price. Then, you sell your put with a strike at least 25% below that value. This creates a powerful double buffer of safety. You're protected by the distance from the current stock price and by the distance from its true underlying value. So let's bring it all together. If you're going to remember just a few things from this explainer, make it these 3 core pillars. Think of this as your cheat sheet. First, monetize your assets without selling them. Second, generate income by selling insurance against market fear. And third, keep your cash completely liquid to seize those rare, game-changing opportunities. That's the entire game plan. And we'll end on this final, profound thought from the source material. The only enemy is greed. This is an incredibly powerful system for generating wealth, but it demands discipline. The math works. The mechanics work. The only thing that can break the machine is human emotion. So go out there, be disciplined, and understand the risks. The power to build this is in your hands.